Welcome to Talking Business, a podcast produced in Melbourne, Australia. The podcast is available on the Acast site, mine website, the Apple Podcast Store, or wherever you go to get your podcasts. Or you can get it at the Business Acumen website at www.businessacumen.biz. For the most exclusive access to leading economists and business leaders from around the world, subscribe to Talking Business from my website, leongettler.com. I am Leon Gettler. My job is to review and monitor the week's news in business, finance and economics. I bring it all to you every week. This is episode number 44 in our series for 2024, and today's date is Friday, November the 29th. First, I'll be talking to Jason Baden, the Regional VP Australia-New Zealand for F5. With the ongoing and growing cyber threats pushing cybersecurity front of mind, Jason speaks about how important it is to invest in continuing education to bolster Australia's collective IT and cybersecurity skill set, given how rapidly and dramatically the landscape is evolving in the cybersecurity space. And I'll be talking to independent economist Craig James, formerly chief economist at ComSec, about what to expect in the market in the following week. But first, let's talk to Jason Baden.
Well, Jason, what are the issues with cybersecurity now?
That is a great question, Leon. There are so many facets to it as we look at it in today's terms. And I think there's a couple of trends that are coming through both globally, but also locally. So at the moment, we've got applications. And when I started at F5 8 years ago, they were all going to go into the cloud. And what we see now is that applications sit sometimes on premises, sometimes in the cloud, some of them in SaaS services. And the problem about that is more than anything, trying to find out exactly where that application is so that you can secure it.
Some of it's mobile as well.
Absolutely. So I think we're all used to using our mobile phones. I do plenty of my applications across that. The point about that is not about where the end user is using it, but where the actual application is being hosted. And so that's the most important thing about getting used to being able to secure that where that is the application actually is being hosted, not specifically where it's being used.
Where it's being hosted, meaning what?
Well, if you say, for example, you've got a banking application that potentially might be in the cloud, it might be hosted by the bank on premises. Depending on where that is sitting, depends on how you secure that and what kind of security portfolio you need to do to be able to get that supported.
Which means potentially every bank and every business would have a different application.
Correct. So the way that we would look at it is that we manage security for multiple different companies. And the way that occurs is that the major banks, the major governments, the telecommunications companies all have different ways of delivering those applications, whether it's to pay your bills, whether it's to get some information, whether it's a banking application. And the most important thing is that wherever that sits, you are able to make sure that you've got that security portfolio covered across all of those areas, whether it's through a laptop, whether it's through a mobile, however you access it.
One of the issues in Australia is we don't have enough expertise to tackle this.
That's 100% correct. And what we see in that specific area is that now you've got very large organisations that can afford to get those resources. However, they're still only finite. But all of those, but everywhere, and I think there was a great article yesterday or the day before, just in the Fin Review, where they mentioned that now they're targeting secondary schools. Now, secondary schools wouldn't have been normally a place where they would have had a great security posture. But now what happens is that you have to have the same security posture whether you're a small organisation or a large organisation, because you're carrying personal data. So the level of skill set or the level of requirement for security now has really increased across all companies, and it's a key requirement.
That would include not only banks and governments, but also hospitals as well.
All facets. So anywhere that has personal information that could be a target, it's any kind of criminal or anybody who's looking to get into an organisation, they're going to look for the weakest link. And so now what you basically need is every single person has to have a great security posture.
Well, a friend of mine who runs a company involved in this says one of the big issues is people just make mistakes. they click on links or they respond to emails they shouldn't be responding to, and they get those all the time. Is that how much of an issue is that?
I think education of every organisation is incredibly important, and every organisation that goes through that. There's one thing from an F5 perspective, we look after the application from an enterprise level, but every organisation needs to ensure that they've got great education across that, because I think there's phishing links, there's all types of areas where those can be contacted. And we've seen that go through that process where people have been, man in the middle, where they've, had their emails covered off or any of those types of things. And that can just come down to straight education often to stop those problems. Ask that extra question, look at what that information that's coming through. That it's just key.
Well, one of the issues, though, is that people making these mistakes are lower down the food chain.
I don't know that that's necessarily the case. I think the important thing is that you've got education across the entire organisation. There's no single one person that everybody is possible to be breached, and therefore that education has to be across the entire org.
So how does an organisation organise that sort of education?
And I can give you the example of what happens in our organisation is that there is always tests that come out. There's phishing that, allow people to be, whether they click on that or not. And then you have those test processes to be able to then go back and educate them if that may or may not be a problem, to stop it at the source.
That's quite intensive.
Yes. Yeah, I think it's critical is that every single person within an organisation is responsible for cybersecurity.
And how much of that would come down to the board of organisations?
Well, there's all different across the world, and especially regions and governments all have different postures in regards to what that is. In Australia, there is a requirement from the board to ensure that they are aware of cybersecurity and they have that personal responsibility.
If people aren't prepared for it, there will be implications for cyber insurance.
No doubt. Yes, no doubt.
Right. Okay. Which is why it's incumbent on all organisations to actually take this on.
Yeah, and let me just give you a story where I think we see this in our day-to-day business is that previously cybersecurity was really an area where companies, it was left to the IT team, to the networks team, to the cyber team, whatever you want to do to call that. But as we continue on, we've seen much more of the business CEOs, CFOs. They are much more interested in what are they spending their money on and what are they getting for that money? And then where is that going, and is that going to cover them off? And I think there's a lot more governance around exactly what are we spending our money on, and is that going to ensure that we've got, our cybersecurity postures all correct.
One of the issues for companies, though, is that they now, instead of just investing in IT people, they need cybersecurity specialists on board. And the question in Australia is, where do you find these?
Yes, look, there will never be enough people, and I think that the universities, the schools, every part that we can do to get that educated. But what we are also seeing, Leon, is that there is an opportunity and for products that allow vendors to be able to do some of that, that real-time monitoring. And that's where we see a huge growth area across that space, because if you can outsource that, or you can get ahead of that curve where you don't need somebody to monitor that all the time, and you can rely on somebody that can leverage a global visibility of problems that are occurring or threats, and that reduces down the need for individuals to manage each one of those security areas.
So what we're talking here is about software?
Yeah, so it's a SaaS service,
Okay.
software as a service. And so that effectively allows you to leverage somebody else's infrastructure to ensure that that security portfolio is then covered off. And we've seen that across multiple areas. APIs are very much open now. You want to make sure that you know where they're sitting and if they're secure.
And indeed, and that would answer the question in Australia that we don't have enough specialists, so you can actually outsource that to SaaS services.
Correct. Yes.
And these are quite effective?
Yes. Well, I think the position from there is you're able to leverage global threats. So let's say, for example, is that if you have a cyber specialist and they are working and you're keeping that application on-prem, they need a level of skill sets to be able to make sure that they can, address all of those threats and keep those updated. Now, if you don't have all of those skill sets and you can leverage somebody who has got a service, security as a service, then what you're doing then is that if there is a threat somewhere else, anywhere across the world, that can then be replicated into your security portfolio before potentially you could be attacked. So therefore, you're reducing down that 0-day issue of being attacked.
One last question. How sharply has this problem risen in the last 5 years?
I think, we've seen that across the board. There's multiple breaches that, have had huge press across them. There's the visibility that brand damage that can occur during that is that the people that have or have not been breached, everybody is being, tested in any one time. And so therefore it's critically important that they've got that covered off. We've seen organizations go through this spend, and at the moment there is a huge amount of investment in cybersecurity across the region. And I hear that from multiple vendors in similar situations to us that companies are investing heavily in this, and that's only increased over those last 5 years.
And we've had so many instances of that happening in major companies such as Optus.
There's multiple companies that this has occurred to across various industries. And I think what it does is it brings it back to the fact that those high profile breaches have meant that nobody wants to be, kind of called out on that, so that everybody's investing in that to make sure that they can avoid that. There's never a perfect situation, and it's but everybody knows that they've got to keep a very close eye on what's happening in that space.
Well, Jason, it's been fantastic talking to you. Thank you so much for your time.
That's all right, Leon. Thank you.
And now let's talk to independent economist Craig James.
Well, Craig, what can we expect in the market in the week starting December 2?
Well, potentially we could expect a bit of volatility because we have a lot of economic data coming out over the week starting December the 2nd. The highlight, I suppose, is the economic growth figures which were coming out on Wednesday. Certainly, economic growth, gross domestic product, has been quite anemic in recent quarters, and that's to be expected. We've had higher interest rates to try and slow down the economy, get inflation under control so interest rates can come down. In the June quarter, there was only growth of 0.2%, so it's only very, very modest growth. And at this early stage, we've got a few pieces of the puzzle still to put together, but the expectation in the September quarter is 0.5% growth, and that'll lift the annual rate of economic growth from 1% to 1.3%. So still very modest growth. Normal growth in the Australian economy is somewhere around about 2 to 2.25%. So when you've got 1 to 1.3, it's sort of quite weak. That probably is the highlight, despite the fact that we've got to always remember that the GDP figures are backward looking, and we've got a number of indicators that will be coming out this week, which will be, or the coming week, will be covering things like the month of October and the month of November. In fact, sort of early in the week on the first and the second days of the month, we get the data on housing prices come out. And we do know that home prices, sort of slowing somewhat, and that's something to be watched out, sort of fairly carefully. Only in October, home prices were up by 0.3%. In some capital cities like Sydney were going backwards. So we've got home prices kicking off the week for the month of November. We've got retail trade figures and building approvals also coming out on Monday, and the business indicator. It includes company profits and wages and the like, and inventories. That's also coming out on Monday. So it's a big day in terms of Monday. Tuesday, we get data on government spending and the balance of payments. Then the economic growth figures on Wednesday. We'll also get new car sales figures coming out on Wednesday. So you'll see how your favourite popular vehicle is faring in the ranks of new car sales. Thursday, we've got international trade and the monthly housing market indicator. And then we've got the labour account coming out on the 2nd. Remember, this is always the precursor to the Reserve Bank board meeting, which is coming out over the 9th and the 10th of the month. So this is going to be the pivotal week, which will determine whether interest rates remain unchanged at the end of this year, or whether we can get a surprise interest rate cut. The latest thinking is that we won't get any interest rate cut until at least February next year.
Certainly, but the thinking is it may be even beyond February, maybe May, or some are even saying August.
Well, yes, it gets down to the indicators of inflation. So we've got to look at the monthly reads of inflation. We've got to look at the quarterly reads. Certainly in the coming week, we've got the Melbourne Institute inflation gauge, and that's widely regarded. In October, there was a 0.3% rise in the month, and that was after some much more modest results in the previous couple of months. August, the indicator went backwards by 0.1%, and September was 0.1%. So very, very soft numbers, but so it was a bit of a surprise on the upside in October. The annual rate from the inflation gauge is at 2.1% though. So if we get a figure in sort of November, which is back on the downside, and we get some really weak economic figures coming out over the week, you could get a surprise, sort of the tail end of the year, because the Reserve Bank will know that it has powerful effects through the December-January period, or it could just hold fire and just wait for confirmation that inflation is indeed under control.
Well, the last minutes of the recent meetings or November meeting, the RBA said that they needed more than one quarterly figure of inflation to be convinced to deliver an interest rate cut.
Yeah, it's an interesting one. That suggests a backward-looking way of approaching sort of the decision on interest rates, that you're looking at sort of prior measures of inflation rather than you're looking forward to see where inflation is likely to be, sort of over the next 6 to 12 months. And the Reserve Bank's got to do both. It's got to look at, so it's got to interpret the figures that are coming out this week and say, what does that mean for inflation going forward? And perhaps it does need one or two indicators of inflation just to confirm things are indeed on the downward slide there, moving back into the 2 to 3% target band sustainably before it sort of starts to cut rates. But the thinking more now is where some commentators suggest that there could be the next move in interest rates could be a rate hike. Now, most of the consensus is we'll get a rate cut, but it won't be until probably sort of around about May or June of the next year.
Because the RBA has to be convinced that the reduced inflation is sustainable.
Yeah, my word. Sort of that's very much the case. Very much the case in terms of the United States as well. Of course, it's cut rates sort of twice sort of already, and the expectation is it'll cut sort of even more at the December 17-18 meeting. The US has got a lot of figures coming out in the coming week as well, just like ourselves. And I haven't mentioned it in terms of Australia, but all around the world we get the purchasing managers readings on Monday for manufacturing, and then on Wednesday for the services sector. So the US certainly has those figures coming out, and they've been sort of reasonably strong sort of late. On that's on Monday. On Tuesday comes out the JOLT survey, which looks closely at the readings of the job market in the United States, and it does show that things are slowing down in terms of the job market. We've got the Beige Book figures or Beige Book report coming out on Wednesday in the United States. That's all important in terms of interest rate expectations too, which is gets a survey of basically how the Federal Reserve districts are faring at the moment. Then we get trade figures and job cuts and jobless claims on Thursday, and then Friday the non-farm payrolls. So this week, at the tail end of the week from the United States, we get that all-important gauge of employment, and it was very weak in the last reading. Was only up plus 12,000. The expectation is that it will rebound in terms of November to plus 194,000. But we'll have to watch that one so fairly carefully, because we have had a degree of softness come in. Of course, there's been a couple of flies in the ointment, things like strike activity and hurricane activity has constrained employment activity in the United States, and that affected those payroll figures for October. But we'll have to see whether it continues into November, and if it does, then that will set it up quite nicely for the Federal Reserve to cut interest rates again in the 17th and the 18th of December. That meeting will also have the dot plot, effectively the forecast of the Federal Reserve members about where they see interest rates going forward. And that's something we don't really have here in Australia. We don't have the Reserve Bank officials coming out with the survey showing sort of where they're all thinking about sort of where interest rates are likely to go over the year.
The issue with the Fed is that they will be looking in the future, because there'll be a new regime coming in with Donald Trump.
Yeah, my word. So sort of that's certainly something the United States has got to take into account. Still, it's important, to take a structured approach with this, because they don't know for certain exactly what the measures that will be taken. They don't know for certain, what sort of policies are going to be adopted. So they've got to take a softly approach, but nevertheless, do the so what question. If indeed there is some sharp tariff increases that are applied, and they're applied, on Chinese goods as well as, say, European or even Australian goods. What does that mean for the economy? What does that mean for inflation?
And so we'd be watching that very closely. And how would you expect the Trump regime would affect the Australian economy?
Well, certainly it's going to be a little bit of a different, affair. If Donald Trump comes down hard on the Chinese in terms of tariffs, and that causes the Chinese economy to slow, that will have knock-on effects to the Australian economy, because we're more providers of commodities or raw materials to the rest of the world, whereas Donald Trump is thinking more in terms of manufacturers, perhaps in terms of some services, but thinking in terms of the United States is better prepared, for the competition that comes from overseas, and anything that sort of sees either the US or the US or the Chinese economy slowing is bad news for us. So it is something to watch fairly carefully, and something that our Reserve Bank has got to take stock of as well. Run the scenarios. Ask the so what question. What happens, if the US economy does slow down sharply because of a tariff war or a trade war? And if that was to occur, what would happen to our economy and what would happen to inflation?
Well, Craig, that's all very sobering. And thank you very much for your time this year. Thank you.
So what's happening in the news? Well, Donald Trump's new tariff pledges send a clear signal that he wants to rewrite the terms of North America's Free Trade Pact and follow through with plans to hit China with tariffs, demonstrating to allies and adversaries alike that he's serious about renewing confrontation over a global trading system that he believes costs the US dearly. On his Truth social media platform on Monday, Trump said he would levy tariffs of 25% on imports of all goods from Mexico and Canada, accusing both countries of facilitating illegal immigration and fentanyl abuse in the US. The Mexican peso fell 1.4% against the dollar in Asian trading on Tuesday, while the Canadian dollar lost 1%. He also promised to levy additional tariffs of 10% on Chinese imports, citing what he says is China's failure to regulate the chemicals that go into fentanyl. Many Chinese products are already subject to average levies of about 15% after the first phase of the trade war that kicked off in 2018 during Trump's first term in office. The Chinese yuan shed 0.3% against the greenback in offshore trading. The major question is whether the threats are a negotiating ploy to wring concessions on trade and other policy priorities from US trading partners, or the start of a sustained campaign to reshape global trade and the American economy. Either way, foreign leaders, business executives and economists are bracing for fresh disruption to a world economy that has just emerged from a searing encounter with high inflation and rocketing interest rates, as well as continued friction over trade. Trump's statement leaves little doubt that the US stands at the threshold of a new era of trade protectionism, said Iswar Prasad, Professor of Economics and Trade Policy at Cornell University and a former head of the International Monetary Fund's China division. Trump's clear determination to use tariffs as a tool of international diplomacy will have significant disruptive effects on US and global trade. A 10% extra tariff on Chinese imports is an opening salvo, said Joe Brusoulis, chief economist at global accounting firm RSM. On the campaign trail, Trump said he would hit imports from China with tariffs of 60% or more. Most analysts expect Trump to ratchet up tariffs on Chinese goods, further tighten restrictions on the export of US technology to China. It will curtail China's investment in the US in an effort to drastically reduce economic ties between the world's biggest economies and geopolitical rivals. A lot of people expect Trump to be a negotiator, so I think this is the beginning of discussions or beginning of negotiations, Michael Hart, the president of the American Chamber of Commerce in China, said in Beijing on Tuesday on the sidelines of a conference on global supply chains. An international analysis by the Reserve Bank of Australia has warned an extreme trade war between the United States and China would drive down the local share market, push the dollar lower, and potentially force the central bank to cut interest rates to prop up the economy. The research, released under Freedom of Information laws, represents the most in-depth insight into the RBA's view of the economic implications of this month's US presidential election. Protectionist trade policies were a key feature of the campaign, with President-elect Donald Trump pledging to slug imports from China with a 60% tariff and levy duties of 10 to 20% on other countries, including Australia. Republican control of both the House and Senate means Trump is likely to face little resistance from Congress as he forges ahead with plans to reintroduce punitive trade barriers, as well as implement his other priorities, including deporting illegal immigrants and cutting the company tax rate to 15% from 21%. The documents released by the RBA show staff analysed the financial market implications of a range of outcomes 3 weeks before the US presidential election on November the 5th. Staff assessed that the eventual outcome of the US election, a Republican sweep of the White House and Congress, would have the greatest implications for the Australian economy and local financial markets. Under an extreme scenario, following a Republican sweep, RBA analysts found Chinese economic growth would slow because of the sharp rise in tariffs. The decline in Chinese activity would have relatively strong negative implications for Australia, given the strength of export trade links. In the extreme scenario, weaker export demand and slower growth would be disinflationary, putting downward pressure on policy rate expectations, government bond yields and the Australian dollar, the RBA analysis said. Equity prices would likely decline as earnings expectations are revised down. Under a moderate scenario, where China's economic growth slowed but global growth held up, the RBA found the Australian economy would still experience a modest reduction in activity, the dollar and interest rates, but the S&P ASX 200 could move higher via a spillover from US equity markets. And Australia's headline inflation rate remained well within the Reserve Bank of Australia's target band in October, but the central bank is likely to want more proof price rises have moderated before it will cut interest rates. Last month, the Consumer Price Index was 2.1% higher than a year ago, the Australian Bureau of Statistics reported on Wednesday. That result compared with the 2.3% pace expected by economists and the 2.1% annual increase recorded for September. The trim mean or underlying inflation rate came in at 3.5%. In September, that measure was 3.2%. The latest data on prices will be scrutinised closely by the RBA and households, hoping for an easing of the cost of living squeeze. The RBA Governor, Michelle Bullock, has said the central bank watches the quarterly dataset more closely than the monthly figures. The bank is also wary that the underlying figures are a better guide as to whether inflation is sustainably within its target range of 2 to 3%. That said, the board may start cutting the cash rate now at 4.35% before the trim mean pace drops below 3%, provided the RBA is confident of a decelerating trend. And the Albanese government's plans to increase a tax on superannuation accounts worth more than $3 million is unlikely to pass Parliament before the federal election, casting doubt on whether the impost will ever be implemented. The bill, which will increase the tax from 15% to 30% from July 1st, 2025, is the only significant revenue-raising measure the government has proposed and comes as the budget plunges deep into deficit. The government is so pessimistic about securing support for the tax increase that the bill has been left off the logjam of priority legislation it is trying to pass this week. This is the last time Parliament will sit for the year, and possibly before the election. Even if Parliament comes back for 2 weeks in February, as scheduled, unless the government agrees to major changes, the super bill has next to no prospect of passing, with every Senate party and crossbenchers opposed to it. The super tax hike, which was a broken election promise, was budgeted to raise just $900 million over the first 4 years, but in its first full year of operation, 2027-28, it was budgeted to raise $2.3 billion and rise steadily beyond that. And higher spending and lower company tax revenue will push the budget into a deeper deficit this financial year, according to economists at Deloitte, who forecast Treasurer Jim Chalmers will have presided over the largest deterioration in government finances on record outside the pandemic. Economic management will be one of the major issues at next year's federal election, amid widespread voter discontent over several years of high interest rates and rapidly rising prices. While Labor has scheduled the 2024-25 federal budget for March the 25th, the